Hello guys, and welcome to today's lecture. This video will be tackling financial reporting and analysis, Reading 8 Financial Analysis Technique, Part 1. This is Bilal Ghattis, and I'm going to be your instructor for today. Before we kick it off, I need to send a special thank you to ThinkWiz for providing me with the quality prep material used throughout this video. Let's get into it. What is financial statement analysis? Financial statement analysis is basically whenever you try to analyze the financial statements of the company. You look into the detailed accounts that it has. You look at different statements where the major statements are the income statement, the balance sheet, the cash flow statement, and the statement of equity. You try to analyze, link, understand in order for you to know how the performance of the company in the past was, how the current performance is, and where the company actually stands, financially speaking, and is there any good future prospects for the company? This is in general. Throughout this lecture, we're going to get into the details of the analysis itself. As for the sources that are used whenever we do the financial statement analysis, we use what we call the financial statements themselves, the notes to the financial statements, and the management commentary. And later on during this session, we're also going to be asking ourselves, are the above sources that I've just mentioned enough, or shall we look for more details? We mostly depend on what we call the annual report. An annual report is a report that is made up of at least three sections. The first section, you're going to find what we call the management commentary. The management commentary is what the management has to say, what senior management has to say about the performance of the company. So you might find the chairman giving a message, the CEO giving a message, the CFO and the COO giving messages and their insights about the performance of the company. And this section can be very valuable because it actually has details that you might not even find in the financial statements themselves, as they can show you figures only. Financial statements. Financial statements is actually there after the audit report. So you're going to see the audited or the unaudited financial statements if you're not looking at an annual report, of course. So the financial statements are basically what we call the balance sheet, the statement of a financial position, P&L statement, the profit and loss, the income statement, the cash flow statement, or the statement of equity or changes in equity. Now, if you want to look and understand the financial statements more, you look at what we call the notes to financial statements. Because imagine that we have a figure in the balance sheet that's called investments and it's worth $50 million. Now, if I want to know the details of the $50 million and how my investments are actually segmented, I would go to the notes of the financial statements and look at the details of and the segmentation of that number itself. Additionally, the notes are important because they give you information about the legal structure of the company. They give you information about the accounting standards and policies. They give you information about accounting changes policies, if any. They give you information about details on the assets, details on the liabilities, details on the equity, details on the income and expenses. They also give you information about credit risk, financial risk, other types of risks. Additionally, they tell you and give you more insights about the off-balance sheet items, contingencies, and maybe potential lawsuits or current lawsuits that are there. As for the analysis itself, whenever you are conducting a financial statement analysis, you need to be coming from a certain background. Am I doing this analysis for equity purposes or credit purposes? Because every analysis should get to a certain conclusion. And is the conclusion or goal that I'm looking for the purpose of the owners? So is it from an owner's perspective? Am I a shareholder? Am I worried about future cash flow generating ability? Am I worried about the risks? Am I worried for potential growth to know how much my share will be worth later on? Or am I a lender? Am I a bank? Or am I applying at a bank to get a certain loan? So you need to put yourself in the shoes of the shareholders or the creditors so that you can know how to design, engineer, and drive the analysis process itself. Points to pay attention to whenever you're trying to conduct your financial analysis. Number one, as we've said before, for every analysis, there should be an objective. So when you put the objective, you need to design and engineer the steps that take you from A to Z. You need to make it in a comprehensive manner. So you need to put everything laid down for you so you know how you can drive to get to the conclusion itself. So what's the objective? What are the steps? What are the sources of information? And then how to use the sources that I have in order to engineer something that I call a financial model, maybe that will give you or promise to give you a certain result that you will use in your conclusion. As for the common financial analysis tools, we're going to be discussing the ratios, and the ratios actually differ from one industry to another, and they differ from one company to another. We're going to be talking about that later on. But the good thing about the ratios is that they remove the size factor, which we will also be explaining later on. And the second type of tool is what we call the comparative analysis. So we have basically two types of general umbrellas of comparative analysis. The first one is what we call the horizontal or trend, and the second one is what we call the vertical or the common size. So whenever we're talking horizontal analysis, we're talking about a certain item that I am looking at while comparing different years with the base year. Whenever I'm talking about a vertical analysis, I'm comparing an item to a total. We're gonna get to that later on. However, you need to understand that analysis can be when a company can compare itself to a certain base year, so it can compare to itself, or it can compare its performance to what we call a peer company or a peer group, as if we're comparing apples to apples. However, pay attention for important steps that might be an obstacle or that might be obstacles whenever you're trying to do your analysis. Number one, pay attention for different currency rates, currency exchange rates. A company can be operating in dollars, other company can be operating in euros, so make sure that you take that into consideration. Another point of difference is what we call the fiscal year. Some companies have their fiscal year ending in December 31st, other companies have their fiscal year ending in September 30 or June 30. So you need to do what we call the trailing 12 month, which is the TTM. To have more details on that, let's go to the whiteboard. Whenever we say TTM, it stands for trailing. It means you go back, you look at the trails, 12 month, which means if a company has what we call Q1 2020 financials released, and another company has a full annual report, which means a year ending 2019. So basically, here's what we call 3-month financial statements, and here's a full year financial statements. If we want to compare both, we cannot do so even if the companies look the same. So basically, they might be operating in the telecom sector. For us to be able to conduct an analysis, what we should do, guys, is we should convert this to look like this because this is covering 12 months. So what we do is we trail back 12 months, which means we take 12-month period. So we need additional 9 months of data for us to be able to make a comparison. So what we do is we include 9 months back, which means Q4 of 2019, Q3 of 2019, and Q2 of 2019. If we add all 3 quarters, we're going to have 9 months. So we add the values and then we pour them on top of the Q1 2020. And this way, we can actually have some kind of a comparison. Another way of actually comparing is what we call normalization, which we're going to be discussing later on. But always pay attention that you're not comparing similar exact dates. So this is for 3 months in 2020, and this is for 12 months in 2019. And sometimes what happens in 3 month period, even if it's a short period, can make a big of a difference, especially if we take into consideration seasonality or cyclicality. The third thing that you should pay attention for is differences in accounting standards. So sometimes you find yourself calculating a certain ratio. The ratio has certain items from the income statement, and you're doing this for two companies. One company abides by the GAAP, generally accepted accounting principles, and the other company abides by the IFRS, which is the International Financial Reporting Standards. And because there are differences in classifications and where you put items and how items are actually shown in the financial statements, the ratios might not be that quite of a good thing to do unless you do what we call adjustments. So sometimes manual work is needed before you actually compare and calculate ratios. So whenever we have accounting standards that differ, some manual adjustments need to be done. Ratio analysis. There are different types of ratios that are used for the financial analysis, but what's really important for you guys to know about ratios is that you need to make sure that the items that you're putting in the numerator and in the denominator are accurate, they make sense, and they truly represent the actual numbers of the company. And then you need to understand the reasons behind the numbers and the reasons behind the changes. Why? Because a ratio will give you a certain number. It can be a percentage, it can be just a number. You can make certain type of analysis when it comes to that. However, the real good analysis comes from understanding the changes behind the items inside the ratio itself. Because if you see a ratio that is increasing, which might be a good thing, saying that a ratio has increased and this is good is not enough. Because this is not analysis, this is translating what you see in numbers to a sentence. When you analyze, you need to get inside of the accounts and see the reasons of change and then make some kind of a conclusion that supports that. So ratios can come from or can be derived from only one statement, or they can be a mix of statements. The good thing about the ratio is that, as I've said before, it removes the size effect. So if you're comparing a company with the total assets of $100 million and another company with the total asset of $250 million, you can do the comparison because the dollars is now not showing. What's showing are the results of the ratios. Okay, but pay attention that you compare apples to somehow apples and not apples to bananas. Then ratios might not really make sense, especially if they're operating in different industries. The good thing about the ratio is that they tell you and they give you a lot of insight about the past, about the current situation, and about the prospects that the company might have. Of course, ratios are very important for investment decisions because we do have some kind of a ratio that we call multiple ratios, and we depend a lot on the multiple ratios whenever we're trying to know the value of a company itself. And finally, guys, as we said, because ratios sometimes link more than one item from more than one financial statement, then they help you understand more and they clear out the relationship between the financial statements themselves. As for the limitations, imagine that we have a company that has many business lines. The first one operates in retail, then fashion, then pharmaceutical, and chemicals. If we're taking the ratio of this company based on the consolidated financial statements of all business lines, we cannot compare it to a company operating in fashion because the consolidated include more than one business line. So what's logical to do is to compare the business line financial statements with the financial statements of that of the fashion. Number two, whenever we look at the result of the ratio, as I've said before, the result is a number. It doesn't tell you all the details and the story. So do not just depend on the number. Dig into the details of the accounts to understand why such a result is there. Number three, consistency. Ratios might not be consistent, and this depends on the cyclicality and on the business cycle that the company is actually facing. Subjectivity. Analyzing and interpreting ratios, as I've said, is not only about the numbers. So sometimes, or the results. So sometimes you need to include your professional subjectivity in the matter so that you can provide an insightful conclusion. But not always using subjectivity is actually great. So this is something to pay attention for. Differences in accounting standards, just like I've said before, whether we're talking about GAAP, IFRS, or any other local accounting standard that countries might use. Then we talk about relevancy. Not all ratios are relevant because sometimes operating in certain industries does not mean that all ratios are applicable to this specific industry. For example, sometimes using a specific ratio might make sense in banks, in banking sector, but it doesn't make sense when we're looking at pharmaceuticals. Also, ratios that make sense in the insurance industry might not make sense in that of the retail industry. So pay attention to that and pay attention to set what we call the KPIs, which are the key performance indicators of every industry by itself. Then ratios can show you what happened in the past and will show you about the current position of the company, but they might not help you in all cases to predict the future performance because the past does not guarantee what's going to happen in the future. It's good to build on, but it's not a guarantee. Also, whenever we look at the formulas themselves, sometimes we're going to see that in the denominator, you're going to see end period results, and sometimes you're going to see average of the last 2 years. So consistency is not always there. So please make sure to look at how the formula is calculated before you actually look at the result of the formula itself. Common size financial statements. Whenever we say common size, we're talking about comparing a company's performance to itself. The company can do that horizontally by picking what we call a base year and comparing the performance of a specific account to that of the same account in the base year itself. Or what we call vertically, which means comparing the amount of that account to a total listed in the same financial statement itself. So if we're talking about the balance sheet can have vertical and horizontal. Let's look at how they look actually by checking an example on the whiteboard. If we're looking at cash, and we have the following years, 2020, 19, and 18. If you set 18 as a base year and you have $10, and in 19 you had $15, and in 20 you had $8. When you're doing the comparison, and if this is the base year, when you compare that way, this is what we call the horizontal analysis. So when we pick the common size horizontal and we pick a base year, we compare 19 to 18 and 20 to 18, not 20 to 19, because this is the base year. If we compare to a base year, this is a common size horizontal. If we look at the percentage change year on year, this is not the common size, because common size horizontal always depend on the base year. So we say that the comparison for 19 to 18 is what we call 15 over 10. So we see the increase over here, which might be 50%. And then whenever we want to compare to 20, we get 8 over 10 and not 8 over 15. So always look at the base year. We can put them in decimals, but preferably would rather have them in percentages. The vertical is whenever we compare the cash, which is a balance sheet item, to a total in the balance sheet itself. And the total that is in most common cases picked is what we call the total assets. So we're going to have a balance sheet. Imagine we have a cash, account receivable, inventory, and for the sake of simplicity, those are the 4 items that I'm going to pick. This is 10, this is 20, this is 50, and this is 20, so the total is 100 of total assets. So if I want to know or to do a vertical common size, what I do is I set those as a percentage of a total, which is the total asset. So I'm going to have 10% over here, 20%, 50%, and 20%, and always the total should add up to 100%. And now I can actually look at how my assets are segmented and which is the bulky figure in my asset, and I can trace it back in time. Now to look at the pros and cons and the benefits of having common size analysis. So usually the balance sheet common size is useful because we're looking at what we call the trend analysis. Trend is going back to time and comparing ourselves and how the structure is actually changing. We can do that to our debt, to our equity, to our investment, to our current assets. All of those could be done. Additionally, it would help us also determine a comparison between our firm and other firms without focusing on size itself because we're comparing percentages to percentages. So imagine we have a company that is leading in the industry and we'd like to follow the path of that company. We can see their percentages and our percentages and try to put some kind of an action plan on how we can get closer to how their structure is. Vertical common size balance sheet. The good thing about the vertical common size balance sheet, guys, is that it shows you the changes when it comes to the composition of the total assets itself. So you can see how your total assets are composed just like we've said earlier. Now, the good thing about the horizontal is that they show you structural changes. And as I've said also, it's important to look at the debt and the equity and try to identify trends and try to see if you want to copycat some kind of a structure that is there for a leading company. Common size for income statement. Whenever we're talking about a vertical common size of an income statement, we're talking about an item in the income statement divided by the total in the same statement, which is total revenues. So in the balance sheet, we use the total assets. In the income statement, we use the total revenues because usually it's the bulky figure and it is the highest figure when it comes to the operations itself. Then we talk about the cross-sectional analysis. Cross-sectional analysis is whenever we analyze ourselves with a peer or a group of peers. And again, always remember to compare yourself with something that looks like you. Do not compare bananas to watermelons. Compare apples to apples. Okay, this is very important. Trend analysis. Just like I've mentioned before, the trend analysis is really important because trends show you the past, and sometimes whenever you need to move to the future, you need to learn from the past. So the past is there to give us the lessons learned that we need to look at, whether we're doing good so that we can capitalize and see how we can expand it, or if we're doing bad, what happened that made us look bad, how can we fix it? If it can be fixed, can we fix it internally or we need help externally? How did our historical information look like? Do we have potential for growth? And so on. Now, whenever we're doing trend analysis, it means we're going back with good amount of data and time. So if we have a new company, it's not that good of an idea to do a trend analysis because not enough amount of data is there. So we say that a trend analysis is good whenever we're looking at a company that is mature and operating in a stable economy. And always pay attention to cyclicality, which is the cyclicality of the economy itself, or seasonality due to the nature of the industry that the company operates in. Relationships among financial statements. It's very interesting and important for you guys to know how items from different financial statements interact. This might be easy for those coming from an accounting background because they know the technicalities of where the financial statements came from and the details of the accounts and sub-accounts and so on. However, it's also important for finance people, even if they're not working as an accountant, to understand where they are coming from and how they are linked. So it's very important to understand the relationship between revenues and total assets, net income and revenues and debt, cash and income, and be able to differentiate among different type of cash items, different terminologies of cash like cash, cash flows, cash and cash equivalent, petty cash, and also differentiate between the revenue, net income, and cash because your ending cash balance is not your ending net income balance. So if you end up with an net income figure of $100 million, it doesn't mean that you're going to go to the company, open the drawer or open your bank account and see them there. Drafts. Graphs are very important, guys. Graphs are nice for your eyes, for the investor's eyes, and for everyone who doesn't like to read a lot and would like to see results in a nutshell. This is why graphs are important whenever you're trying to show conclusions, whenever you want to have a complicated manner look a bit more easier and simple, and whenever you want to focus on a specific type of the business or a line of a business. The three most common graphs that are used are, first one is the pie chart. The pie chart is nice if you want to resemble how much is an item consuming as a chunk out of the total pie chart that you have. So for example, if we're looking at the investments item or account in the balance sheet, you can look at what type of investments is actually consuming the biggest chunk in the pie. So if we have this investment, I'm not going to get too technical about it. I'm just going to say it in a simplified manner. So imagine those are the equities, and those are the corporate bonds, and those are the T-bills. You can see that the T-bonds, which are the treasury, they consume the most out of the investment chunk, and those are the equities, which are the preferred, common, and warrant, and those are the corporate bonds, which are bonds issued by corporations. So pie charts can actually show you how the composition is changing by time. You can add one, you can delete one, so you have only two sections. Pie charts would be really nice to show this in an easier way. Line charts are really also interesting because they show you the change in amounts and also the growth by time. Going back to the example that we've had before, I'm going to go to the whiteboard. So imagine that we have the following total assets: cash, accounts receivable, inventory, and fixed assets. So a stacked column is a column that shows you the total assets, how much they are, and how the total assets are actually segmented in a single bar. So this is the cash, this is the account receivable, those are the inventories, and this is the fixed asset. If for the next year you've seen the following, this is the cash, this is the account receivable, this is the inventory, and this is the fixed asset. It means that cash have decreased, as you can see. Cash have decreased when it comes to total of total assets. Account receivables have increased. So basically, you've used the cash maybe to purchase more inventory, so that because you expected to have more sales, which was reflected over here. So account receivable increase, so that can mean a lot. It can mean you've loosened up your collection policy, you're selling a lot. Maybe you gave a new collection terms which have been extended for your clients, or you're not able to collect your account receivable in an efficient manner. So a lot of reasons can be there. Maybe you ended up using the cash. However, you overstocked your inventory, so now you have more than what you should have had in the first place. And out of the total, your fixed assets have decreased, maybe because you've had some kind of depreciation, so the accumulated depreciation increased, so your fixed assets decreased, or you have sold a portion of your fixed assets, so now the total is less. Regression analysis. Regression analysis is one of the really important topics for you guys. You're going to see the details of that in level 2. But for level 1, we're just going to give a bit of an introduction about it. Regression analysis allows you to do two things. Number one, it allows you to forecast. You can be forecasting your income, forecasting an income for a specific business line, forecasting your growth, forecasting your increase in costs or decrease in costs. So forecasting is there. And number two, regression analysis helps you really understand relationships among variables. So you have a lot of variables that you might want to study the relationship between them, and regression is a great tool to do so. Finally, guys, This is a teaser of part 2. So in part 2, we're going to be looking at the following financial ratios. Ratios are divided to activity ratios that focus on the daily operations, liquidity ratios that focus on the short-term liquidity, which means the ability to utilize my short-term liquid assets to cover my short-term liabilities. Solvency, which is the ability to meet my long-term obligations. So I'm not talking about less than a year, I'm talking about more than a year, I'm talking about a structure itself. Profitability, what is my profitability margins, what are the ratios that are used, and how and what do they show me, and how do I analyze them. Valuation ratios, which are the ratios that help me try to give a certain intrinsic value based on prospects that I have. And then I'm going to be talking about also the usages of all the type of ratios that I have mentioned earlier. Thank you for watching, guys. I hope that you have enjoyed. Again, a special thank you for ThinkWiz for the prep material that they provided, which I have used throughout the video. If you have any comment or question, drop it in the comments section. If not, kindly give me that thumbs up like button and subscribe to my channel to stay notified of the videos coming soon. Have a good day, guys. Thank you.